Welcome, everyone. Quick disclaimer, this is not investment advice. Now, let's jump in. Let's take a look at the bold predictions of two leading macro strategists, Henrik Zeberg and David Hunter. Both expect a vertical move higher in U.S. stock indexes over the coming months, followed by a very severe market crash. What signals will they watch to identify the top of this bubble, and what are their targets for the peak and for the crash that follows? Let's dive in.
At some point, there's something that's going to break. So when people are saying, oh, that was a black swan event, it's never a black swan because it always happens. All black swans, they happen within a recession.
Henrik Zeberg is a macro strategist and chief macroeconomist at Swissblock. He focuses on the economic cycle, investor sentiment, and the relationships between different markets. His core thesis is that the top in U.S. equities is not in yet, but that only one final, likely very fast speculative phase remains. Henrik is talking about a time window of just a few months. So what are his current targets? His main target for the S&P 500 is around 8,100 points. For the NASDAQ, he believes there may still be roughly another 15% upside, which would take the NASDAQ composite somewhere close to the 30,000 level. On Bitcoin, Zeberg believes that the longer-term bear market has already begun. But before the real decline takes hold, he expects one final powerful rebound. In that last risk-on phase, he also expects Ethereum to outperform Bitcoin in percentage terms. Let's try to summarize what Zeberg sees as the most important signals for identifying the top of this stock market bubble. First, the indexes reaching their technical targets. Zeberg will be watching whether the major U.S. indexes reach the target zones calculated through Elliott wave analysis and Fibonacci projections. Second, Asian markets as a preview of the final bubble phase in the U.S. According to Zeberg, Asian markets could first experience a parabolic move higher, followed by a sharp decline. After that, capital could rotate back into U.S. assets and create the final, most extreme phase of the bubble on Wall Street. Third, capital rotation and animal spirits. He wants to identify the end of the bull market by watching for a massive rotation of money into the riskiest assets. He is especially focused on whether Ethereum starts to significantly outperform Bitcoin and whether capital begins flowing aggressively into altcoins, meme coins, and other speculative assets. In his view, that would signal the final stage of market euphoria. Fourth, technical signals and extreme volatility. According to Zeberg, the path to the top will not be calm. The market could be full of violent swings, false breakouts, and technical warning signs. These chaotic moves may actually be one of the signs that the bubble is entering its final phase. Fifth, the bond market as a warning signal. Another important signal would be a sharp decline in short-term yields, while long-term yields remain stable or even move higher. According to Zeberg, this would suggest that the market is starting to price in a more serious economic problem and a potential Fed response. Sixth, stress in the economy and the financial system. Zeberg is also watching consumer weakness, the labor market, jobless claims, credit spreads, and broader credit stress. A major warning sign for him would be if initial jobless claims rise above roughly 250,000 per week, while credit spreads start to widen at the same time. Zeberg will not try to time the top using just one indicator. He will be looking for a combination of reached technical targets, final stage euphoria, capital rotation into the riskiest assets, warning signals from the bond market, and worsening data from the real economy.
And what does Zeberg expect after the bubble burst? In his view, this will not be a normal correction, but a crash of a generation. The bursting of a bubble even bigger than 1929, 2000, or 2008. And this crash, according to him, should not be limited to stocks. It could also spill over into the real estate market. Zeberg expects the final decline to push Bitcoin all the way down into the extreme $3,000 to $4,000 range, while the US dollar should strengthen significantly. But after a full-blown market crash, he believes the Fed will step in with massive money printing. That, in his view, would release the inflation monster once again, creating an extremely favorable long-term environment for gold and silver. At the very top of the bubble, Zeberg favors TLT, long-term U.S. Treasury bonds. The reason is his expectation that the first phase of the crash will be strongly deflationary. Personally, I do not focus too much on the exact price targets, and I would be very surprised if most of them played out precisely. But the broader pattern, a final blow-off move in risk assets followed by a severe crash, seems quite plausible to me. I cannot really remember a time in history when such a vertical rise was followed simply by a calm sideways market.
Around here, but in response to the global bust, you could see as much as 20 trillion or more come in increase in the Fed's balance sheet. That means, from that 9 trillion, you could go to 30 trillion, and obviously from
David Hunter is an American contrarian macro strategist and the chief macro strategist at Contrarian Macro Advisors. He has spent more than 50 years on Wall Street, and his approach is based mainly on contrarian analysis of sentiment, market cycles, liquidity, bonds, and institutional behavior. His core thesis is that the U.S. stock market has not yet completed its long-term bull cycle. According to Hunter, we are now in the final parabolic phase of a 44-year secular bull market, a phase that could still bring extreme upside over the next few months. After that, however, he expects a global bust and a very deep bear market. So, what are his current targets before the market peaks? Honestly, they sound pretty crazy, but then again, these are pretty crazy times. Hunter has recently raised his targets again. For the S&P 500, he is now talking about the area around 10,000 points. He sees the NASDAQ Composite around 36,000, the Dow Jones around 67,000, and the Russell 2000 around 4,000 points. He also still expects more upside in semiconductors, with the SMH Semiconductor ETF potentially reaching the area around 800. And in precious metals before the bubble bursts, he expects gold to trade around $7,000 and silver around $200. Let's try to summarize what Hunter sees as the most important signals for identifying the top of this stock market bubble. 1. Extreme FOMO and the disappearance of fear. David Hunter is not always looking for exact index levels. He's watching crowd behavior. In his view, the top will be marked by the complete disappearance of today's caution. The market will enter a state of extreme euphoria and an all-in mentality, where both large and small investors jump onto the moving train driven by pure fear of missing out. People will stop waiting for corrections. Instead, they'll start throwing money into the market almost blindly. 2. A change in the Wall Street narrative. Another warning sign will be a clear shift in the rhetoric of major analysts and strategists from large financial institutions. The end of the bubble will be getting closer once these experts start confidently saying that the current bull market still has another safe 2 or 3 years ahead of it. At the same time, the dominant market narrative will be that falling inflation gives the Federal Reserve a clear path to aggressive interest rate cuts. 3. Falling oil prices and easing geopolitics. An important macro trigger for the final phase could be a calming of global tensions, specifically a resolution around the situation around Iran. According to Hunter, this could send oil prices sharply lower into the $70 to $60 range, which would push inflation down and provide relief to consumers. This mix of cheaper oil, a weaker US dollar, and lower interest rates could serve as rocket fuel for the very final stage of the rally. 4. A parabolic rise across the entire market. The price action just before the top should be extremely vertical and steep. And unlike many recent rallies, Hunter expects this parabolic move to broaden out well beyond the big technology names. In his view, financials, commodities, and smaller companies could all join the final surge, potentially with very large gains. There is also one older idea from David Hunter that I find especially interesting. Back in October 2025, Hunter talked about the possibility of a sharp 10 to 20% decline after the market reaches its top, followed by a relatively quick rebound back close to the highs, and only after that, the main crash. I remember a very similar pattern from the year 2000. In my view, the market recovered very quickly and moved back close to the top, even though the fundamentals were already breaking down. And only after that did the main decline really begin. A similar pattern also appeared around 2007 and again in 2008, although the 2008 version happened deeper inside the bear market.
If something like that happened again this time, I definitely would not want to be standing on the sidelines. From those heights, the market would have a very long way to fall. Once the market reaches its peak, which Hunter currently estimates could happen around late summer, early autumn, or possibly by the end of the year, he expects a historic and merciless crash. In his view, the market will collapse because it is sitting on an unsustainable global debt burden of roughly $348 trillion. Stocks could fall as much as 80% from their peak. So, for example, if the S&P 500 reaches 10,000 points at the top, it could eventually fall all the way down toward 2,000 during the collapse. According to Hunter, this decline would unfold in stages and could last roughly 12 to 18 months. Precious metals would not be spared either. If silver peaks around $200, it could fall by more than 50%, back below $100. Gold could decline by 30 to 40%, potentially toward the 4,000 area. Oil would collapse as well, driven by massive demand destruction, possibly falling toward $30 per barrel. And during this brutal deflationary episode, the yield on the 10-year U.S. Treasury could fall all the way toward 0%. This enormous decline would eventually force central banks to start printing massive amounts of money again in order to save the banking and financial system from freefall. But according to Hunter, the response would come with a delay. Because of the consequences of previous crises, policymakers would be hesitant to use these tools immediately, and that hesitation would make the decline even deeper. The Federal Reserve's balance sheet could then expand from roughly $6.7 trillion today to as much as $30 trillion. This new flood of money would first stabilize the system, but with a delay of several years, it would unleash a massive inflationary cycle, with inflation potentially reaching as high as 25%. In that next cycle, the main winners would no longer be passive holders of large technology indexes. Instead, leadership would shift toward commodities, energy, industrials, materials, miners, and real assets. Gold could rise to $20,000. Silver could reach $1,000. Oil could climb to $500 per barrel, and copper could move toward $20 per pound. But David Hunter does not stop there. He then expects a final collapse and depression around the middle of the 2030s. In his view, markets will not be able to survive an environment with 20 to 25% inflation and bond yields above 20%. With debt service costs at those levels, the system would become completely impossible to finance. The rescue tools would fail, and this would trigger a massive, final global depression around the mid-2030s. That, according to Hunter, would mark the end of a giant century-long supercycle and the end of the current fiat and Ponzi system as we know it. Of course, these forecasts are extremely dramatic and, for my taste, perhaps a little too specific. But at the same time, I also do not expect the next 5 to 10 years to be a calm and easy period. For me, the bigger extremist is someone who says that AI will simply save everything, that we are heading into endless market growth, extreme AI-driven deflation, and near-term abundance for everyone. So, as always in the stock market, everyone plays their own game. And I wish you the best of luck enjoying the ride. Enjoyed the video? Like and subscribe. If not, hit subscribe anyway and be as happy as possible.